Good morning and good afternoon, everyone. It is December 11, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Macro Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that the webcast and your questions may be recorded. Today, we'll focus on two key topics. So firstly, we'll address the implications on multiple fronts after the recent events in Korea. And then next, we'll move on to China and share our thoughts on latest policy signals. So for speakers today, we have Jun Sok, South Korea Equity Strategist and Head of Korea Financial Research, Kathleen Oh, Chief Korea and Taiwan Economist, Get-Deng Koo, Asia Macro Strategist. And on the China side, we have Chloe Liu, China Equity Strategist, and Cai Zhipeng, China Economist. During this webcast, you can send the questions at any time from the Ask a Question text box. So first, we'll start from China, and then let me hand it to Chloe and Zhipeng. Thank you.
Thank you, Crystal. So I'll start on the macro side. So the CEWC is probably going to be concluded today, and there will be a minutes coming out of at around 7 or 8 p.m. today. We think, judged by this pre-CEWC Politburo meeting statement, the tone will be equally, positive. Actually, this Politburo meeting on Monday sent the most aggressive stimulus tone in a decade. They mentioned about, the monetary policy being moderately easy. That's the first time since 2011. Fiscal policy should also be more proactive. That's also the first time since the 2020 COVID shock. The Politburo meeting also mentioned to intensify unconventional countercyclical adjustment. That wording is also the first time ever. Meanwhile, it also called for further supportive measures to the housing and the stock market stabilization. So all these are very positive wording. And not only that, judging from the text of this Politburo meeting, we also see some subtle shift in policy stance in the sense that expanding domestic demand is probably going to be key task number one for 2025. Whereas tech and supply chain upgrade will probably rank as number two. This order is slightly reversed from the 2024, where tech and supply chain was ranked number one, and the domestic demand expansion was ranked number two. And what actually happened this year is that for all these consumption trading program, the actual implementation only accelerated after late July. So that means if it's ranked, expanding domestic demand is again regain the position as the number one key task. We do see the possibility that a lot of these consumer trading program will be more proactively implemented next year to try to basically forge a healthier circulation in the economy where demand and supply will be more balanced slightly, at least on the margin. So all these are very positive signals. And to summarize, basically this Politburo meeting extended this policy pivot since September. We always think, this policy pivot was not about downside protection. It's not about a temporary measure, but it's about trying to improve people's livelihood. It's trying to exit this deflationary spiral among these asset prices, inflation, wage deflation, and as well as, weaken corporate profitability. It's about basically policymakers are trying to basically reignite animal spirit and try to forge a positive expectation on all these asset prices and wages. So given that this is a very positive, Politburo meeting, what's the implication on our, economic and policy forecast? I will start with something that is changed from these very positive meeting minutes. We think the official deficit will be 4% of GDP versus our previous expectation of 3.5 to 4%. So that's slightly positive and will be interpreted positively by the market. We also think there will be incrementally more focus on consumption. That means, the consumption trading program will be expanded from currently just household white goods and autos to incorporate more like, fast-moving consumer goods such as, mobile phones or even like apparels, etc. Maybe also even some services. So basically, this consumption stimulus program will be greatly expanded, and the funding will also be expanded from currently 150 billion for this year towards something around 300 to 500 billion next year. That's what's changed our forecast. But what hasn't changed is our expectation of augmented fiscal deficit expansion. We still expect around 2 trillion RMB in terms of augmented fiscal expansion. And within that 2 trillion expansion, supply-centric measures is probably still taking the lion's share. And as well, also on fiscal monetary policy, we expect 40 basis points, policy rate cut from now until the end of next year. That's slightly above market consensus. At the same time, the PBOC may also cut RRR to accommodate all these government bond issuance. Now, some clients have asked us, what does unconventional countercyclical adjustment mean? What are the potential unconventional, economic policies? I think, to understand that, we probably need to put this unconventional in the context of China's own policy making in the last decade, instead of comparing it with developed markets. So in our view, these unconventional easing measures could potentially include, number one, the central SOEs issuing special bond backed by the central government. We already seen, 500 billion, special, investment bond being issued by two central SOEs in the past week. But in the next year, there might be more of that coming. Number two, maybe tighter coordination between the Ministry of Finance and the PBOC. I think that's also one of the key areas that's differing. It's quite different from the past, where now PBOC is more actively buying government bond from the secondary market as a way to inject liquidity into the market. And year to date, it has injected 2 trillion RMB in terms of liquidity into the banking system via government buyback, government bond purchases, and also reverse repos. And number three, we also think probably the central government will use its own balance sheet to stabilize the housing market, and as well as improve the social welfare system. So these are the new measures potentially to be rolled out, so we view them as slightly unconventional. So these are what's likely to be coming out on the policy front. On economic forecast, we remain quite cautious. We maintain our forecast of 4% real GDP growth and 3% nominal GDP growth. Basically, this round two policy to be issued by the CEWC is probably not going to be sufficient to reflate the economy. And we are closely watching for our social dynamic indicator as an early sign for round three policy, which will be probably more sizable and also more consumption centric in our view as well, to be more effective in terms of reflating the economy. Now, today's Central Economic Work Conference, it will have a minutes, and we think because it will have more details compared with the Politburo meeting, it can also have more positive wordings regarding some subsectors, for example, housing or consumption sectors. So the market could view these new positive wordings positively. But overall, we are maintaining a relatively cautious growth and policy forecast despite this positive tone from the policymakers. In our view, there are some constraints facing the policymakers. Number one, this old school supply-centric thinking on policy. It's slightly shifting on the margin, but I think it will still take time for the policymakers to entirely break this old school thinking. Number two, because this current economic downturn is not entirely cyclical, we also think it is structural. So in this sense, Beijing thinks structural reform and cyclical policy easing need to go hand in hand. And because structural reforms are very difficult to implement, that means without further progress on structural reform, the size of cyclical policy easing is unlikely to be a bazooka. It's probably still going to be ramped up at a relatively gradual pace. So that's why we remain quite cautious on the actual size and mix of the policy, despite this very positive tone from the Politburo meeting, as well as possibly today's CEWC. So overall, we think we're still maintaining a relatively cautious economic and growth forecast, economic and policy forecast. But we do believe that the policy pivot since September is real, and the policymakers will continue to to try to ramp up policy, and also try a little bit of a trial and error approach in terms of rolling out new stimulus measures in terms of maybe some incremental consumption stimulus as well as some social welfare spending. Yeah, I'll stop here.
Thank you, Zhipeng, and then let me pass it to Chloe.
Thank you, Crystal. Hi, everyone. This is Chloe, China equity strategist. So on the Politburo meeting, as Zhipeng mentioned, we think it sets a very positive tone. It indicating a clear policy focus shift, and we expect more easing can come. And this is a good follow-up to the initial policy pivot signals from the September meeting. The market rallied in the beginning, but it faded very quickly afterwards. So based on our investor feedback, we think there are a few concerns or takeaways. Firstly is on the monetary policy side. This is very positive. The official tone has changed from prudent to monetary easing. And the last time when the Politburo meeting mentioned monetary easing was in July 2010, when after the global financial crisis. However, some investors think this is more of a summary of what's happening now, because the monetary policy has been very loosening since 2021. And although we expect more risk card and triple R card to come, the marginal impact of the monetary easing is declining because of the overall demand is very weak. So the key is on the physical stimulus instead of on the monetary easing. And secondly, although the meeting indicates a very clear policy focus shift, some investors think the policy pivot is already priced in, with MSCI China re-rated from 8.5 times PE in August to 10 times PE now. What the market wants to see is the actual size of the physical stimulus, especially on the consumption front. So people are basically standing on the sidelines to wait for the CWEC today to see if any more clear colors can be provided. On the expectations for the CEWC, our accounting continues to expect an augmented physical expansion of renminbi 2 trillion in 2025. And I think the market expectation is around renminbi 2 to 3 trillion. So this is where consensus sitting in at this moment. If we see more fiscal stimulus from the CEWC, we think the MSCI China 12-month forward PE could test 11 times or higher multiple versus current level at 10 times. The last time we see the 11 times PE valuation was in early October. However, it was not sustained due to lack of policy follow-through. So we think the potential for this level to be sustained is likely to be small if we see any of this following happens. First is the CEWC is still overly prudent about the physical budget deficit expansion. And secondly is lack of more detailed policy follow-through, particularly on the consumption and housing stimulus measures in the next couple of months. And certainly is any explanation of geopolitical uncertainty after the new US administration comes in on January 20th, 2025, such as if more severe than expected tariff or non-tariff measures potentially could lead into the weakness in the renminbi. So our accounting continues to expect the physical expansion of renminbi 2 trillion in 2025, which is not enough to turn around the current deflation situation immediately. So we do not see enough evidence yet to turn more bullish on the sustainable China equity market rally that could last longer than a few months. And we will continue to monitor the upcoming policy events and action changes. So how to positioning? We still advise to investors to be cautious until we see more clarity on the policy follow-through. But we think our bookcase stock screening, which includes 24 stocks, based on our earnings framework, provides a good selection of high beta stocks with solid fundamentals. With that, I will stop here and pass it back to Crystal.
Thank you so much, Chloe and Zhipeng. And then we will address all the China-related questions offline, given they have a meeting right after this. And now we are moving on to Korea. And then let me invite June, Kathleen, and get for their thoughts on the market implications after the recent political events that happened in Korea. Firstly, to Kathleen. To June, actually. Sorry.
All right. So let me just go through what's been happening in the past kind of 8 days and what to look for going forth. So it's been, 9 days since the martial law declaration. And if you look at Kospi, it moved down, 5.6% the first 4 days. We've recovered, and it seems like there's a bit more stabilization now. And but this, the political situation still remains quite fluid. The first impeachment vote that took place last Saturday, out of the required 200 out of 300 lawmakers, only 195 actually voted, and 194 seemingly voted for the impeachment. So the next one is actually coming up on Saturday again, and at 5 p.m. So we need to see how that kind of plays out. Just before this webcast, there was actually a speech made by the president. And the key takeaway there is that it seems like there is going to be no stepping down. And so the impeachment process will probably just continue. And, heading into the voting this time around, they need 8 votes from the ruling party, because there's 192 from the opposition side that has actually voted for the impeachment. So how many of the lawmakers from the ruling party actually moves to that side needs to be seen. And it seems like, media is reporting that there is at least more ruling party members that will be actually taking part in the vote, because last Friday, actually, except for 3, all the other ruling party lawmakers did not participate. So that's the key thing that's to look for in the next 2 days. Now, just the process itself, if the impeachment does get passed, the next step is going to be the Constitutional Court. And to confirm the impeachment, they have to get it done within a 180-day period. And actually, even on Saturday, if that does get passed, they could actually submit it to the Constitutional Court during the weekend. So in the case of President Roe in 2004, it took around 2 months. In 2000, during the President Park in 2017, took around 3 months. So that's kind of the timeline that I think many market participants are looking for. Now, if there is a confirmation, the next step would be a presidential elections, and that has to be held within 60 days. So it does seem like the scenario is kind of a late 25 election, assuming that impeachment goes through. Of course, if it fails, then the opposition is saying that they will have more votes going forward, and the president will obviously stay on his executive office position. So there's still a lot of uncertainty here. Just on the market side, I mean, one of the key questions that we've been getting is, what's the downside from here? And also, what about the reform agenda that's been being pushed forth by the government? So, I mean, if there's any kind of real stress in the market, we've been hearing from the financial authorities that there will be support provided, stock stabilization fund. Also, there's been, I think, funds right now being provided to the ETF side for the value up. So there is, I think, we kind of believe that, if it heads towards 2,300, there would be this kind of financial support being provided. And I think in terms of the value up or the reform agenda, generally, all the value up agendas already kind of been implemented, such as the disclosure system, the value up index, ETFs. And it was really about the value up, tax measures, which did not get passed. And even before the martial law event, the opposition party did say that they would not be passing that. But the leader of the opposition party has said that for the shareholders, dividend tax reduction is something that could be considered. So, heading 2025, that's one thing that we could kind of look for on the tax side. And I think it's interesting to hear that, the opposition party lawmakers did actually visit KRX to discuss these kind of stabilization measures, and also on the value up of the reform agenda. So we believe, this is actually a good timing to continue to push this through. And if there is stress in the market, not just stock stabilization measures, but this would be another way. Reform agenda would be another way to support the market. So just the last point I would make is that, linked to that, again, a lot of questions why the financials of the bank stocks were more hard hit. And it's, again, linked to the fact that, value up there may be a bit of a derailing there. That was concern, which we don't really think that is the case. It's more about delay. The weakening Korean won was obviously another factor, and how this affects capital management. So, and other question we received was on financial support, such as windfall tax, and we believe that the windfall tax is not something that should be a concern in the near term right now. And there's also, I think, a substitute called the Mutual Prosperity Program that is actually probably more flexible and also has a direct impact on the weaker links, such as the small businesses. So that's probably going to be the way that financial support is provided by the banks. And so just generally, I think right now, with the multipolar world, the tech down cycle, and the risk of tariffs, we've been cautious on the market, and our Asia strategist, Jonathan Garner, has an underweight on Korea. So I remain a bit cautious here, but if there is any kind of, let's say, positive developments on the current political situation, we saw that in previous cases where there has been a bit of a short rally. So let me stop here.
Thanks, Drew. And then next to Kathleen.
Hi, thank you, June. Hi, everyone. So I wanted to discuss the implications on the economy from the recent event. Of course, our view remains that the near-term impact on the real economy remains relatively limited. We continue to see exports slowing down, and that would be the larger drag on the economy next year rather than this short-lived martial law that we just witnessed past week. As June mentioned, things are still very fluid. We just had President Yoon holding a press conference and showing his intention not to step down voluntarily. So that means impeachment bills will continue to go through. And depending on the decision of the National Assembly, whether it goes to the Constitutional Court or not, it looks like it will be at least a quarter or so of a uncertainty on the political side in Korea. But again, listening to the local authorities from this event, we've heard that the BOK governor coming out on Bloomberg TV last week, showing his confidence that the economic dynamics would not be affected by the political dynamics in Korea. And although just yesterday he did mention that the weaker dollar-won trend might continue, not entirely due to the domestic situation, but of course the global external demand, external backdrop. And the fact that BOK shows that they are aware of this tells us that the BOK probably will continue to go on to their cutting cycle, but at a paced manner, as we have been calling for after the back-to-back rate cut we've seen in October and November. But from here, because of the increased risks around FX and extended volatility on the FX market, we think the BOK will continue with their cutting cycle, but at a paced manner in a quarterly 25 basis cut from here. And our terminal rate for the BOK sits at 2.25% by the third quarter this year. That view has not changed after the political events or ongoing political events. I would say at least one good news we heard this week was the passing of the 2025 budget. Of course, a lot of uncertainties still remained on the budget, whether that could get passed within this year. If not, then it would have been another layer of uncertainty added to the economy, given that we might have witnessed an unprecedented shutdown of the government. But the positive news was that the opposition party did pass the original budget with a cut that actually was announced before the martial law declaration, about 4.1 trillion around the reserve funds and some of the expenses of the presidential office and president's national security staff members. But despite the cut, we think the larger allocation of the major budget spending on the welfare, the economic investments, and the budget for the household sector still remains untouched, mainly the larger chunk. So in that sense, we would continue to expect the fiscal spending will be enacted as scheduled. But again, because of a small cut, the budget for next year, which was already quite a conservative increase from last year, from this year, is now even smaller than the previous original draft, meaning that this tight budget and also weakening outlook on the economy driven by the export slowdown and also this uncertainty on the domestic side would call for expansionary fiscal policy to return in Korea. And our view is that the supplementary budget is likely to be executed next year. The realistic timing of the supplementary budget would be mid next year, given that the Korea National Finance Act states that in order to execute extra budget, the original budget needs to be exhausted at least more than half. So in that sense, we will expect the original budget to be exhausted in the first half, front-loaded probably 75% of it, and then the execution of or the proposing of the supplementary budget will take place. For us, the size of the supplementary budget, we're expecting between 1 to 2% of GDP, which is the usual size of the supplementary budget, other than the time of pandemic, which we saw more than 3% of GDP of the extra budget. So 1 to 2% would mean 20 to 50 trillion Korean won. We think that would be the well anticipated size of the supplementary budget in the second half of the year to support the domestic recovery. Again, things are still quite fluid, but for us, the macro view has not changed, although the downside risk remains because of the potential prolonged uncertainty on the political front. But the domestic fundamentals continue to pose what we had expected in our outlook, and we continue to see the growth forecast for next year, 1.7, unchanged, despite the event last week. I'll stop here.
Thank you, Kathleen. And then last but not least, let me move on to Gag.
Sure. Thanks, Crystal. So yeah, in Korea, the impact of the political developments on the FX and rates markets really depends on when and how the current situation gets resolved. Because like Korean won is actually usually driven more by what's happening in the global space rather than what's happening domestically, which is why actually in our 2025 outlook that we put out in mid-November before the recent political events, we had already laid out a cautious outlook for the currency, expecting it to revisit the previous highs around 1440 by the middle of next year. So the thinking there was that against this global backdrop of the US likely increasing tariffs on Chinese goods, Korean won would be one of the most exposed currencies to this within the whole EM complex because the Korean economy has high exposure to trade and the renminbi, and it doesn't seem to have benefited that much from the supply chain diversification since 2017 if we look at how it's lost market share in the global exports market. And on the domestic front, the flow of funds outlook for Korea was also not looking that positive for the currency because for this year, we could say that the current account surplus has been improving and providing a tailwind, but then that's expected to turn into a headwind next year, given that we're expecting exports to slow with the turn lower in the memory cycle and the slowing of the US and Chinese economies, which are the two largest export partners for Korea. So by definition, this would mean that the financial outflows from Korea should reduce, but then we think the currency might not benefit as much as one might expect from this, similar to what we've seen in the early part of this year when Korea saw huge equity inflows from foreigners, but then the currency didn't rally. And that's because we think the dollar-based investors will still be able to get a yield pickup from hedging their Korean won exposure next year, which gives them the incentive to hedge, right? Particularly given this backdrop of trade tariffs. So the recent political events domestically just adds to this cautious outlook that we've had, given that the uncertainty is not great for sentiment. I mean, so far what we've seen is that the impact of the political events on portfolio flows seem quite modest. Like equities has only seen about $640 million of foreign outflows, and bonds have seen inflows actually of about just over $800 million. So it depends on how quickly and how the current situation gets resolved in order to sort of see the more lasting impact on portfolio flows and on the currency. For example, if we do get the political uncertainty persisting for a prolonged period of time and it starts to impact the progress of some of the capital market reforms or the ability of fiscal policy to respond to the economic pressures, then that could be one factor that weighs further on Korea's portfolio flows. So from here, in the near term at least, we think Korean won is likely to remain volatile in response to how things develop on the political front. So if we look at the performance of dollar Korea relative to the other dollar AXG currencies since last Monday, which is before the political events happened, or if we compare to where dollar Korea is settling around now, which is around this 1430, 1435 level versus where it was before, which is around 1400, then we can sort of estimate that markets have priced in around 2 to 2.5% risk premium for the domestic political uncertainty. But looking at our idiosyncratic risk premium model for currencies, the amount of risk premium that's priced into the currency right now is actually not that high. So that means the currency is not cheap enough for us to consider fading the move just yet, especially given the situation is still very fluid and uncertain. So that's sort of how we're thinking on the FX front. Medium term, the outlook still looks more on the cautious side, but then near term, it could be a bit more volatile depending on how the political developments go. And then on the rate side, the questions have centered around whether the recent political events will have any implications for Korea's weak B inclusion. And at this point, we don't think so, because Korea will likely still meet the criteria for weak B inclusion based on how things are looking. Because if we look at the qualitative criteria side, the reforms have been passed and implemented, and they're unlikely to be reversed. And on the quantitative criteria side, Korea's credit rating is currently 4 levels above the minimum that's required with a stable outlook. So the two ratings that matter from the S&P and Moody's, and S&P has said that the recent events are unlikely to trigger a change in the credit rating for the next 1 to 2 years, whereas Moody's is saying that the political uncertainty will need to be prolonged and start to impact economic activity before it's seen as credit negative. So that's why in terms of the inclusion, we don't think there will be a change. But the key thing to watch here is on a timeline, because the preparation works are currently ongoing to get the operational setup ready for the inclusion to take place in November next year. So if there's any impact from the political developments on the preparation works and when it gets set up, then it could delay the inclusion timeline. So this is one thing to watch for. But generally on the rates front, we do still think a flattener in Korea rates curve versus the US curve makes sense, because I know some investors have started to expect expansionary fiscal policy, which is clearly possible. But then because of the uncertain timing, like, it's also possible that we get a period of sort of prolonged uncertainty and the limitations of fiscal policy to respond to some of the economic pressures. So if that's the case, then we also could get the curve to flatten, right? So whereas in the US side, we do expect that the Fed's going to be more dovish than what markets are pricing in. So the curve should steepen there. So that's why we do think the Korea curve could be a bit more stable relatively to depending on how the political developments go. But versus the US curve, there is room for it to flatten. And then maybe just to add a quick word on the China side, given the discussions earlier. So what does the outlook that Japan and Chloe laid out mean for China rates and FX? I would say on the FX side, given the positive tone that we could get out from the CWC, as Japan laid out earlier, it could be positive for the currency. But then after the Reuters article that we saw yesterday with saying that the PBOC is considering allowing the renminbi to weaken next year to offset the impact of tariffs, we might also need to look out for whether they could change the language on FX, which so far has been keeping the exchange rate broadly stable around a reasonable equilibrium level. So if they do change that language at the CWC, then it could offset the positive impact from the policy signal side. But if it stays unchanged, then actually into year end, we do see a couple of potential positive catalysts for CNH to do a bit better into year end. Besides this CWC, we usually do see Chinese exporters increasing FX conversion in December. So we actually do see the effect of that in the seasonal performance of the CNH as well, where it tends to go up in December. So that could be one positive factor. And then the other thing is also on the dollar side. Our G10 strategists actually just pulled the trigger on turning a bit more bearish on the dollar, thinking that a lot of the good news on the US side has been priced in. So if we do get the dollar weakening, then that could also help in terms of the near-term pullback in dollar CNH. And for now, what we've seen is that the dollar CNY fixing has been kept below 720. So you could say that limits the upside for dollar CNH for now, until we start to see more concrete plans around the US tariffs. Then potentially the currency could then move a bit higher in terms of dollar CNH. So near term wise, it looks like there are some positive factors for CNH, but we think that the upside for CNH should be limited given the underlying risk of trade tariffs. And we can't rule out the possibility of headlines on this front, right, until the end of the year. So given this prospects of the tariffs, and also the fact that our economists haven't really changed the view on the size and the composition of China's fiscal package next year, we think any bounce in CNH should be quite limited, and also would present an opportunity to fade. On the rate side, we've seen quite a big fall in China yields after the Politburo meeting, particularly in the long end of the curve, which is interesting given this policy mix of more expansionary fiscal policy and more easy monetary policy that's been signaled. So we think it could be due to markets already having the expectation of more expansionary fiscal policy after the September policy pivot, and we didn't have really any new information, you could say, that to change investors' assumption on the size. Whereas on the monetary policy front, the change in the stance was a little bit more of a surprise, you could say. So actually the focus has been a bit more on that front in the bond market. So it seems to suggest lower rates for longer, which is why we've seen this pretty big rally in terms of China rates. So we think it makes sense to still look for lower China yields, given the more dovish monetary policy stance that's been signaled. So we actually still like receiving 1-year China rates. It's a trade that we've been suggesting for a couple of months now, and we still like it. So yeah, with that, let me pause there and hand it back to you, Crystal.
Thank you so much, Gag, June, and Kathleen as well. And now we'll move on to the Q&A session, and you can submit your questions by using the Ask a Question text box on the left-hand side of the screen. We have 3 questions for June, and then given the time constraint, I'll just ask everything together. So the first one is on short sell ban, and what's your view on the probability of it being lifted next year in March, or you could see a further extension of that? And then the second one is why Korea banks rebounded strongly despite the political uncertainty. And the last one is, if the president does get impeached, is it a net positive for the value up or boost up plan? Thank you, June.
Thank you for that. So first on the short sell ban, there was a meeting with the FS governor and some of the foreign investment bank analysts and strategists, which I did also attend. But basically, the FS governor made a statement that for the short sell ban, all efforts would be made to get the necessary approvals and also the system set up by end of March, so they can actually have the short sell ban lifted at that point. So there's no real change, I think, in the position. End of March has been what the FSC chairman has mentioned. So I think that just stands still at this point. In terms of the Korean banks, if you look at the first kind of 4 days, actually the banks were probably the most hard hit among the subsectors, and of course there's others like the industrials. But I think the reason why there was a bit of a rebound here, I think, is number one, the fact that the won has actually kind of stabilized. I mean, it went to like 1440 level, now 1430. And the reason why that's is important is because if the won continues to weaken, it has a bit of a negative impact on P&L, but more on the capital side, and it could impact the near-term capital management plans. So that was kind of the concerns here. I think in terms of the won, we'll have to see how it moves, but if it stays kind of this level or actually strengthens, then it's going to be actually a boon. The second is also related to the value up or the reform agenda. So there was a lot of concerns that was surrounding like the windfall tax and generally the potential of the policy direction being somewhat less favorable for the banks. But again, as I mentioned, that in terms of the windfall tax, we're still kind of leading that rather than have that being passed, because even during 2023 when that first came out, it wasn't that universally well taken even within the opposition party. So the mutual prosperity program, although it's quite negative for the banks because they're also hit by it last year, but again, there's a bit more flexibility there, and I think if the macro conditions keep tough, yes, that would be there. But those kind of, I think, changes to the law, like such as windfall tax, doesn't seem that probable at this point. And with the value up plan, which is again, I think one of the reasons why the banks kind of rebounded is that we think a lot of the value up plan or program is already kind of played out, and now as we get into the let's say the next steps, and assuming the president, there is a change in the presidential office. Let's say, for example, if the opposition party's candidate does become the president, they have their own plan, which is basically the boost up program, which includes like fiduciary duty to the shareholders for the BOD members, and there's other changes to governance that's in there. So I think there's generally, I think when talking to investors, there's increasing kind of consensus that there does need to be these governance kind of changes, and also on the capital markets rules, there are some pending bills out there, and if the political situation stabilizes, maybe that could actually get done a bit more, I guess, easier. So I think again, that's kind of way we see the value up, the reform agenda, because it is not really, I think the situation is very ripe right now to get that agenda being pushed forth, because there's a lot of structural issues that needs to get also, I think, addressed here, includes like super aging and the low birth rate, and also the high leverage levels for households. So we do think that it right now is a time where these reforms are actually needed. So I'll stop there.
Thanks so much, Jun. That's super clear. And the next one, there's a question for Kathleen. So what's your view on, or what will prompt a further expansion in fiscal policies in Korea? And what are the other signs we are watching for a meaningful turnaround for Korea economy?
Sorry. Yeah, thank you for the question, Crystal. I think at this point we need to see the clarity over the exports front. Of course, we have this political uncertainty domestically, but historically, unless this continues or persists more than 2 quarters, the impact on the domestic activities are relatively manageable. And then now we have the fiscal expansion that could come in to support the consumption recovery, which I think could offset some of the uncertainties that could be posed from the domestic side. But for me, the bigger concern remains on the external front. After the president-elect Trump comes in next January, and how the tariffs on China unfolds from here. And again, we do see the risk of a bilateral tariff even on Korea, given that the Korea's trade surplus has nearly tripled from 2017-18 period. So in that sense, I would say if there is a larger than expected shock from the tariffs or any trade barrier related measures that could have a larger downside pressure on the economy, in that case, I would then see the supplementary budget growing larger to the 3% of GDP size rather than the 1 to 2% of GDP, which I mentioned as our base case expectation. And also for Korea to turn around, again, we think it has to be the exports. Of course, we're looking at the memory down cycle rest of this year and also 2025. And the slowdown in the US for 2026 is also another area we're looking for slow exports recovery for Korea in the next 2 years. But if there was any positive news coming out of China or the US growing faster than we had we're forecasting now for next 2 years, then I think that could be a good news for Korea. And also this more ramped up policy support from the government and also the BOK continuing with their rate cuts should put positive upside pressure on the domestic consumption, should also put a positive direction from here, which we think would happen more in the second half of next year rather than earlier part of 2025.
Thank you. Thank you, Kathleen. And then last, very quickly, a question for Gag. Given the very resilient CPI release last night, do you have any changes in the currency or rates view?
Yeah, sure. Thanks for the question, Crystal. So yeah, in terms of the impact on the CPI on the currency side, I would say not really, because if we look at the details of the inflation print, right, actually it's showing that rents and OER inflation have decelerated in November. Which is probably a positive take from the Fed's perspective, because it gives them a bit more signal that actually inflation might be remaining on a downtrend here. So actually our economists are sort of saying that they think the print yesterday gives the Fed increased confidence that inflation will stay on a downtrend, and therefore they also stick to their outlook for a Fed cut at the December FOMC meeting next week, and also additional policy cuts and policy rate cuts in 2025. So actually, if we sort of take that into account, then basically it's you could say that's broadly in line with what our economists are expecting in terms of the Fed policy path, which has been factored into our FX and rates views. So that's why we actually don't think there's any change there. We still think on the G10 side, we're still thinking that the dollar has room to weaken, given that a lot of the positive news has been priced in with regards to, say, US economic outperformance, and also the bearishness on the Eurozone front with some of the political situation in France, and also a dovish ECB, and whereas on the rate side, our US rates team still likes to receive like the January FOMC meeting. So yeah, that's all how we're thinking.
Thank you, Gag. And finally, in the interest of time, we'll conclude this webcast here and answer the remaining questions offline. If you find the session useful and you want to join our other series, or go to the Asia Research landing page on the portal for a collection of the region's most important research and our audio-video series. Thank you again for joining, and do reach out to me and the team if you have any other questions. Have a nice day.